Hello, everyone. Welcome to our Composer webinar on how to trade as a business. I'm Michael, a product marketing manager at Composer, and I'll be your host today. We're thrilled to have Brian Rivera with us, a CPA, YouTuber, and founder of TraderTax CPA and TraderFyles. Brian has helped provide expert tax strategy services to hundreds of active traders, as well as high net worth business owners. And today he's here to walk us through what it really means to treat trading like a business. Brian, welcome.
Hey, Michael, thanks for having me.
To kick things off, could you share a little bit about your journey, how you got into trading, your work on YouTube, and what inspired you to start Trader Files and Trader Tax CPA?
Yeah, absolutely. So by trade, I own a CPA firm, and so that's kind of what my discipline and my skill set was coming out of college. And so my CPA firm has two divisions. One is it's called Hourglass Advisors, and that does more fractional CFO and accounting work. And then we also have Trader Tax CPA, which focuses on the active day trader, so traders and investors. And so we help them with consulting, entity formations. We do the tax compliance, and then we also do tax planning for those that are doing really well in the market. The other thing I have is I also have TraderFyles, and that TraderFyles is a software startup company that helps solve one of the pain points, which is wash sales, mark-to-market reporting, just making sure that what the broker is reporting is translating to the end user's tax return. So how I got into all this, though, it actually all started in the stock market. Is because back in 2014, I had gotten a bonus from my job and I was trying to figure out what to do. So I looked at real estate, I looked at a lot of different markets, and I just found that short-term day trading was something that I wanted to, try my hand at. And so I started trading, and it started with penny stocks, trading things that were, 10 cents to $10, figuring out different ways to generate money. Finally, things started clicking. Fast forward, things started clicking, and it was able to generate some pretty good money in the market. And I had to figure out what to do with it because I didn't want to give it all away to taxes. And so that's how I started diversifying into multiple businesses and things like that. So YouTube that came along the way is because I kind of wanted to start documenting my journey. Maybe when my kids get older, they can look back on some of the videos I put out and see what their dad was doing when he was in his 30s and when he was in his 40s. And so that's just kind of a documentation thing that I do, and it's also to help other people out there that might be struggling with different problems around business, finance, taxes, trading, things like that. So that's how I got into YouTube.
Awesome, awesome. Thanks for that, Brian. Um,
Yeah,
we
absolutely.
received a lot of great questions from our community for our session today. Um,
Hmm.
I'll just give a quick look at the topics that we'll be covering in our session
Sure.
today. So first, the different business structures that traders can use. Then we'll touch on some of the key tax considerations and strategies for traders. And lastly, we'll cover some special cases and some practical advice for traders and of all levels, and followed by a live Q&A. So let's dive straight in.
Absolutely. Let's do it.
So let's start with the foundation. So setting up a business for trading. First question to you is, what are the requirements for starting a business account for trading?
Yeah, so obviously that's going to vary by brokerage firm, but at a minimum, the documentation that you're going to want to present is going to be your filing documentation that you have with your state. So that's going to be articles of incorporation or articles of organization, depending on your entity structure. You're going to need a federal tax ID. And so think of that as like your social security number. That's what we have here in the US. Social security number identifies an individual, but you'll have a federal tax ID or an EIN number that identifies your business. So you're going to make sure you have that paperwork. Any operating agreements that you might have. So the operating agreement could be as simple as, hey, I'm an LLC taxed as an S-Corp. My registered agent is located here. This is how much I'm capitalizing the business with. That's my capital injection. And any special elections that you might have in there. So maybe you want to elect mark to market. So the operating agreement is a good place to document all those things. So that paperwork is what you're going to submit to your broker along with their application process. And usually that's enough to get the account set up and things rolling.
Got it. Makes sense. And if you were to compare that, like if you were to set up an LLC
Hmm.
versus an S corp or a C corp, or even as an individual, what would you say
Mhm.
are the advantages of trading through an LLC versus the other options?
Yeah, so trading as an individual, let's start there. So trading as an individual, automatically the IRS is going to bucket you as an investor. And so as an investor, you get limited tax write-offs, you get limited tax breaks, limited deductions because you're not trading as a business. Now you can graduate to a point where you can qualify as a business still under your name, but you have to meet this IRS standard, and I'm sure we'll get into it a little bit later. It's called traders in securities or trader tax status, where your trading habits have to rise to a certain level to where you can claim what's called trader tax status benefits. Now, skipping over to the LLC is kind of like the first step in saying, okay, hey, look, I'm not just doing this for fun. This is just not a side hustle. This is not a hobby, but I'm looking to treat this as a legit business. So the LLC, you're going to file your incorporation documents, all that good stuff, and then you're going to start trading under that business account. And so the benefits there is going to be, one is you have the ability to write off business expenses. So those are things that are going to be ordinary and necessary to run an actual trading business. And then from there, you can play with your tax treatment. So you can be an LLC that's taxed as a sole proprietorship. You can be taxed as an S-Corp. The S-Corp has some really cool things that I typically like is because, you can do things such as writing off health insurance, especially for the ones that out there that are self-employed. You can write off your health insurance. You can pay officer compensation. And when you pay officer compensation, you have the ability to contribute funds into retirement accounts. And usually those are very popular tax breaks for traders is because you're already comfortable investing your own money. And so now that you can take a business write-off, right, and inject it into a retirement account, and if you can grow that retirement account, at a faster rate than whatever the market is producing, then, you're basically getting tax deferred growth at a faster acceleration rate. C Corps, usually not a fan of those for trading businesses, but they do produce a flat tax rate. But the big problem there is that you could have money trapped inside of that entity structure and you're going to run into double taxation. So usually what I like to see, depending on your structure, is usually a single member LLC or an S Corp, especially if you're out there self-employed.
And I think you mentioned something along like trader tax status, and I think that segues
Mm-hmm.
us really well to the next question. Somebody from our community asks, how does one qualify for trader tax status, and is an
Mm-hmm.
LLC or like a business entity required to qualify for that?
Yeah. Yeah, so to answer the second part of that question, a business entity is not required to qualify for day trader tax status. So we'll get the easy part out. Now, going to the first part of your question, to qualify for day trader tax status, you are going to have to meet the criteria that's listed out in IRS tax topic 429, which is trader and securities. And what's in there is it's actually very, very vague. So if you actually read it, you're like, the world is this, like, it doesn't even make any sense. Like there's no quantification of what they're saying. And so we have to point to case law. So case law shows different traders that may have had run-ins with the IRS and what the actual opinions that came out of those court cases. And so based on those court cases, we're kind of able to telegraph how to qualify for a trader. So that's how we come up with the criteria. And so I came up with this acronym that really was designed for our staff in our firm to like grade our clients based on their qualifications. So we call it the behave test. Behave test is simply just an acronym that we use to meet your qualification or to qualify you as a trader. And this is based on a 12-month year. So the B is going to be business expenses. So we're just looking to see if you have business expenses that are reasonable, ordinary, necessary for a trading business. So you got a home office, you got multiple monitor setups, you got data subscription services, you got composer subscriptions. Like there's all these things that you're paying to basically set up this business. So E is we're looking at equipment, which I kind of alluded to, but you got office furniture, you got computers, souped up computers, monitors, private servers, things like that. So we're just looking at, okay, does this guy have or girl have equipment that's customary to a trading business? The H is we're looking at hours in the market. And so you got to spend at least 20 hours in the market. And that is both technical and fundamental analysis. So you're reviewing charts, you're reviewing, 10Ks and 10Qs, SEC filings, doing whatever you need to do to approach the next trading day. We're looking at average holding periods. So usually an active trader does not hold positions longer than 30 days. So there's a lot of turnover, meaning you're in and out of positions because the IRS wants to see volume. But if you're swinging positions here and there, not a deal breaker, but on average, you want to see a lot of volume being rotated. So the V is going to be volume of trades. So in a given year, you want to have 720 trades over a 12-month cycle. And so if you're actively trading, that should not be a problem at all. And then the last E is going to be the extent at which you trade. So what that means is if you're trading the US market, stocks, equities, options, markets, you have a possible 252 days in a given year where you can trade. So IRS wants to see, based on court case, 75% of days traded. So if you do the math, you got 189 days that you have to meet to qualify as a trader. So in my experience, looking at thousands of returns year after year after year, what we've noticed is that the two areas where I see people qualify or disqualify is going to be volume, 720 trades, and extent, which is 75% of market days. So if you hit those two, the likelihood that you qualify is probably 99% plus.
Got it.
Sorry to be
Okay.
so long-winded. That was a long one.
No, I love how you kind of break it down into just the acronym BEHAVE. I think that
Mm-hmm.
simplifies it for a lot
Yeah,
of people. Um,
sure.
so the next question is it's kind of interesting. Are there any advantages to forming a trading LLC in, let's say, Nevada or Wyoming while you're
Mm-hmm.
living in another state like California?
Yeah. Yeah, I don't want to be the deliverer of bad news. So if you are looking at just from purely from a tax saving standpoint, usually incorporating out of state is not going to save you any state income tax. And that's just because, you pay tax based on your home of record or your primary residence. So if you live in California and you incorporate in Vegas, you can do it, but you're still going to pay state income tax based off of the income that you generate in California. The other thing is you're going to have to maintain two registrations, so one in Nevada and then one in California. Now, the advantages and why people actually go out of state is because there are favorable laws, especially in Delaware and Nevada, for people that incorporate. So like a lot of times software companies will incorporate in Delaware. But a trader, you're not providing any services and you don't have any products or any customers. So I think the likelihood that you get sued or any legal ramifications is pretty low. And then the other reason why somebody would want to go to these states is for identity purposes, right? So you don't want all your information online. You don't want people to be able to look you up. And so a lot of times Wyoming, Nevada, those places are really good for basically, remaining anonymous. So they can't see a lot of your personally identifiable information. Now, I will say, though, there's this whole BOI report that depending on what week you're looking at, you have to do it. You don't have to do it. You're going to get fined. You're not going to get fined. So if that stays, as of today, it's not here. But if that thing stays, then, there still be some personal information on the internet.
Right. And a follow-up to that question, and I think you touched on this before with regards to like
Mm-hmm.
trader tax status. If I had an existing LLC, can I still
Mm-hmm.
qualify for trader tax status, even if I didn't have even if I didn't have that status previously?
So when we talk about trader tax status, you want to remember that there's actually two components to it. So the first component is business expense treatment, meaning, hey, you have a legit business, you can write off the expenses associated with that business. And the second component is what's called Section 475 mark-to-market accounting. And I'm sure we're going to get in wash sales and things like that, so I won't go too deep. But when you think of trader status, just think of those two things. The benefit is business expenses and 475 mark-to-market accounting. Now, if you have an existing LLC, you could trade through it, but you got to make sure that you have the election on file. So that election has to be filed by April 15th. Well, actually, let me take a step back. If you have an existing LLC that has filed a tax return, then you actually have to go through the election process, which is you're going to attach an election statement with your tax return or extension by April 15th, notifying the IRS that this entity is going to elect 475 mark-to-market accounting. And then you'll finish that process the following year by filing a change in accounting method with the IRS, which is called Form 3115. Now, if you're a brand new entity, meaning like you're saying, hey, look, after this webinar, I like what this guy's saying. I want to set up an LLC and I'm ready to get going. Well, you can actually elect mark to market on day one. So then now you don't have to file that paperwork with the IRS is because you're telling the IRS from the day that I open this business, I'm using mark to market accounting. So you don't have to go through that whole process. Hopefully that makes sense.
And we'll touch on mark to market
Yeah.
election in a little bit too. Um, but yeah, let's move on to the second section, talking more about taxes. Probably the
Mhm.
part that most traders dread. Um, but before that, I'll just answer some quick questions in the chat here. And um, I did get one quick question from Jason here. Um, and he asked, can the trading volume be a mix of both futures trading and options trading?
Yeah, that's a great question. So all trading counts. So doesn't matter the market, Forex, futures, crypto, all that stuff counts. As long as you're trading, all that goes into the pot of calculating your day trader status.
Perfect, perfect.
What doesn't count? Retirement account trades. That does not count towards trader status.
Okay, great. So let's move on to taxes. The first question is, what tax advantages exist for trading under a business entity?
Yeah, so we kind of touched on it earlier, but if you want to think about it, is if you're not in an entity, then you must qualify for day trader status. Hands down. So the tax advantages one is to expense things that are helping you generate alpha, which is revenue. So if you're expensing things like me, for an example, is I might upgrade my trading system, I might upgrade my monitors because that stuff is exclusively used for trading. I might upgrade, like I'm in my home office right now, so I might upgrade some of the stuff I have inside of my home office that's directly attributable to me generating money in the market. So the advantage is you can expense things that can basically reduce the total gain that you're showing if you qualify as a trader.
And is there a minimum capital requirement to start trading as a business?
There isn't, but if you think about how trader status and all that stuff is achieved, depending on the type of account you're trading. Let me take a step back. So if you have a cash account, your trades are gonna clear T+1. So as long as you have settled cash by the next day, you can actually generate enough trades. But if you're using like a margin account, I believe margin changed from T+3 to T+2, but if somebody will correct me if I'm wrong. But so trading on margin now, you got to have accounts that are over $25,000 minimum equity because you won't be able to generate more than 3 out of 5 trades in a rolling 5-day period. So I've seen it done different ways. Traders are creative, man. They'll figure out ways to get in that market every single day. So there are different ways to get around it. Or I've seen it where people spread capital across multiple accounts. So let's say I put 10 grand over here with Robinhood or 10 grand over here with another broker. So now you're able to kind of generate trades, depending on what broker you're at. So yeah, I mean, there's a lot of different ways to slice that pie.
Got it. And the next question kind of goes back to what we were talking about when you were mentioning, mark to market elections. So
Mm-hmm.
this question is about how does that really work? How does mark to market work, and when is it beneficial?
Yeah, so mark to market is beneficial in basically, let's say, 2, maybe even 3 areas. First is I'm sure a lot of your audience is probably going to run into this is wash sales, right? So basically, a wash sale is if you take a loss on a position, you turn around and rebuy it within 30 days. That original loss is disallowed, and then it's added to the cost basis of your next trade. So if you're an active trader and you're trading the same names over and over and over again, you're basically going to have a situation where you're going to be flagging wash sales all day, every day. And it's basically an accounting nightmare because the average brain doesn't process a trade as, oh, I made a wash sale and I retraded it, so I got to find the cost basis. The average brain just looks at it and says, hey, I bought this and I sold this. This is what my gain is and this is what my loss is. But the wash sale kind of complicates that. And the reason for that is because there's this concept called tax loss harvesting. And back in the day, what hedge funds would do is they would say, okay, hey, look, I'm up $1 million this year. but I have some losers in my portfolio. I know I want to be a long-term investor in these things, but I don't want to pay tax on $1 million. So let me go ahead and just kill this position to bring down my taxes. And then when January 1st hits, I'm going to turn around and rebuy it so that way I can have exposure to this name that I believe in, that I think is going to, appreciate in value. And that's when the IRS came back and said, no, 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 no. You can't hold a position, take the loss, and then turn around and rebuy in 30 days. That's considered a wash sale. So that's how this whole rule came about. So as an active trader and someone that's in the market day in and day out, how you get around this is you elect what's called 475 mark-to-market accounting. So the first benefit is it gets rid of wash sales. So you are reporting your gains and loss as of the end of the trading day. So there are no wash sales, realized gain and loss. Now, with that said, there's no more long-term capital gains. So if you hold a position for a year, it's going to get marked on December 31st, whatever the value of that position is on December 31st, whether you're in an unrealized gain position or an unrealized loss position. That position gets marked to market and you get to pay tax, or you use the benefit of the loss against whatever you've realized. So main benefit is no wash sales. Second benefit, ordinary loss treatment. So you're not under the capital loss rules. So the way the capital loss rules work in the United States is that, let's say I lose 100 grand in the market. The IRS or the capital loss rules allow me to deduct $3,000 against any types of income, whether that's a W-2, whether that's an Airbnb, a small business. I can take $3,000 against other sources of income. Now, $97,000 becomes a carryover to the following year. So then the following year, if I have some type of capital income, maybe I sold a rental property, maybe I made money in the market, maybe I sold some crypto. Let's say I made 97K. I have a loss that's going to completely absorb that $97,000 gain, if that makes sense. Now, as a mark-to-market trader, though, let's say you got a 475 election, you hit all the requirements, you're a mark-to-market trader. I lose that same 100K. Well, now that's an ordinary business loss, which is going to offset any kind of income dollar for dollar. So let's say I have a W-2 job where I make 150,000. I got a 100K loss. That's going to offset the 150K W-2, assuming I did everything correctly. So that'd be a massive refund of the federal taxes that I paid on my W-2. Or maybe I have an Airbnb or I have other businesses. Doesn't matter the type of income, that will basically offset that income. So just to recap the summary for mark to market in section 475 is you get rid of wash sales and you almost have an insurance policy, as if something goes wrong in the market, you can take full losses against all other income. Cool.
Awesome.
I know that was a lot.
Yeah, really appreciate like the real life, examples like that.
Yeah,
really helps
sure.
with understanding the concepts. Um, I guess another question that not like very related, but can I defer trading taxes without using an IRA?
Without using an IRA. Yeah. So basically, what triggers the taxes is the holding period, right? So if you hold something greater than 12 months, you've got long-term capital gains treatment. So that's 0, 15, or 20%, depending on your tax bracket. And then anything under 12 months, which is most active traders, you're going to get short-term capital gains. So the minute you hit that sell button, you've triggered a taxable event. But again, if depending on where you're at in the year, you can offset that with your gains and losses throughout the year. So the only way to defer that is if, one, you hold longer, get long-term cap gains. Two is through tax deferred accounts like retirement accounts, HSAs, things like that. But outside of that, there is one thing that you can do, but the tax rules are starting to change, is you can reinvest some of that profit into an opportunity zone fund or an actual opportunity zone piece of real estate that you've identified. But that's a whole nother conversation that I can go down. But outside of that, there's not much deferral opportunities for short-term day traders.
Got it. And on that note, like in terms of common deductions, I know you mentioned some of them beforehand, but for
Yeah.
traders, what are some of the common deductions? And if you could
Yeah.
list.
Yeah. So some of the common deductions that I see, especially the ones that are, let's say, going to move the needle, because, if you're taking $20 here, $30, I bought them out, like that stuff's not going to move the needle. So the stuff that moves the needle I see is, one is the home office deduction. The way the home office deduction works is you can use the simplified method where the IRS gives you basically $5 a square foot up to 300 square feet. So that's a $1,500 write-off. But a bigger way to write that off is if you use the actual expense method. And what happens is you take the square footage of your home. So let's say it's 2,000 square feet and your home office is 300 square feet, whatever that math is, what's that, 30%? Let's call it 30. Let's say 600 square feet. That's 30%. So 30% of your household expenses that are indirectly related to that home office can be deducted. So your utilities, your mortgage interest, and your mortgage taxes, insurance, if you have repairs and maintenance. So if it's directly related to your home office, fully tax deductible. If it's indirectly, meaning like, let's say I changed my roof. Well, the roof is not directly related to my home office, but it does impact the house. So the 30% of that cost can be written through the home office deduction. So that one, hands down, I always look for when we're reviewing a client's taxes. The other ones, margin interest. So if you're a trader that trades on margin or portfolio margin, those fees can definitely rack up, especially if you're in multiple positions. The other thing is stock locate fees. That's a big one. And this is probably not going to apply to this particular market of trader, but stock locate fees is something that adds up. Subscription services. So if you're a composer client, you have I know there's an annual fee attached to your account. So that's a business expense that you can write off. If you're in chat rooms, education, coaching, big one. If you're going to meetups, if you're going to conferences, there's a lot of stuff out there that you can deduct. So on average, I see anywhere between $10,000 to $15,000 of expenses that traders are using to elevate their trading, for sure.
Note to chat, if you have a business entity and you're like
Yeah.
a trader, you can deduct your composer subscription fee. That's a big one for sure.
Yep.
Last question for this section. How do K1s and 1099Bs work together for tax reporting?
Yeah. So so 1099B is kind of like your transcript from college. Like this is what the broker is saying. Hey, look, these are all the trades you did. This is what we're tracking as your sales proceeds. This is what we're tracking from a cost basis perspective. Your wash sales if you're not mark to market. So when you look at that, that's basically the transcript of what your broker has. Now, sometimes their records may not correspond to what your records are. So you might have to either there might be some back and forth, or if things line up, then there's not much you need to do. So as a trader, your job is to take that transcript and translate it into what the IRS wants you to report. So if you're not a mark-to-market trader, you basically need to report all of your trades on what's called a Form 8949. And that just lists every single trade that you've executed in the year. And that 8949 kind of flows into Schedule D, which flows into either your personal return or your entity return. So if you don't know how to do that, there's a good company out there. I know it's called TraderFyles, shameless plug, but you could use that software and it'll actually convert that data for you if your 1099B is reported properly. So again, 1099B is just your transcript that the broker is required to report to the IRS. I believe it's February, I think it's either 15th or 28th each year that the broker has to report that to the IRS. Now, where the K1 shows up, K1 is your pass-through income or loss from your business. There's only two entities that are going to generate a K1. That's going to be an S corporation or a partnership. And so if you think about what those entities are going to house, is they're going to have your trading income or loss. They're going to have all your business expenses. So when you aggregate all that stuff, the K1 is going to say, okay, hey, look, if me and you were 50% owners, you would get a K1 for 50% of the profit and loss. I would get a K1 for the 50% of the profit and loss. I take that K1, I go back to my accountant, I go back to my CPA and say, hey, look, filter this through my personal return. So it's almost just a transcript of what your pass-through income or loss is from that business. So to summarize, the 1099B is basically an input that would go into your entity.
To be honest, that sounds complex. So I think, if you need some advice or help, definitely,
Yeah.
come over to TraderFyles and,
And then one of the things that we do in our firm, myself and one of my other staff members, is periodically throughout the year, we open up our calendar and people can do paid consultations. And so maybe you don't need a new CPA. Maybe you just have some questions where you're like, man, I can't sleep at night. I need to talk to somebody who might know exactly, my situation. We do make our calendars available throughout the year. Like it's not available right now just because we're in tax season trying to service our clients. But I was looking at some numbers. I've done 1,500 unique calls since I think like 2017. So I've talked to almost 1,500 paid, not even clients, we're just talking paid consultations over the last like 7 or 8 years. So yeah, I've done this a lot.
Awesome. Awesome. Um, yeah, let's move on to the last section here. Um, this section is really about talking about more about some real world scenarios that we often
Hmm.
hear from our community. And the first question for this part is, if I had a full-time job and trade on the side, should I use an LLC?
Hmm. Should you use an LLC? Well, you can. Yeah, I would definitely do it is because that's going to legitimize your trading operation. Because if I were the IRS and I was going to critique what you were doing, and I'm like, well, wait a minute, you're not really trying to generate money because you have a W-2 job. So maybe you're not serious enough to do it. But I think this is like your flagpole in the sand saying, hey, look, I'm trying to legitimize what I'm doing. So I'm going to do this through an LLC. Although I have a job, I still meet all the requirements. Maybe I live in California, so I get up in the morning, I get up at 6 a.m., whatever the time is when the US market opens, and I trade the morning session, and then I go to my W-2 job at 9:30. So there's your 4 hours right there. Or maybe even the night before, you were doing a lot of prep. You were, looking at the market, you're looking at all these crazy headlines going on, and you're setting yourself up for the next day's set of trades. And so, yes, to answer your question, yeah, LLC definitely legitimizes your trading business.
Makes a lot of sense. And I think you mentioned before, you just brought up the word crypto previously, but
Hmm.
how does,
Yeah,
trading in crypto apply to all of this? Is it the same, would you treat it the same as, trading stocks, et cetera?
sure.
Interested in your insights.
Yeah, so cryptocurrency, just think of it as just another asset class. So it's taxed exactly the same way. So if you hold a stock for 12 months or more, long-term capital gains. You hold a cryptocurrency coin for 12 months, long-term capital gains. Same thing on the loss side. There's short-term capital losses, there's long-term capital losses. So everything is the same. The difference is cryptocurrency is not subject to wash sales. So you don't actually have to worry about wash sale treatment and making sure that you're not trading during certain trading windows is because you can actually use tax loss harvesting with crypto and jump back in and not worry about having a big fat loss deferral that carries into the next year. What else with crypto? And then crypto, the only unique thing I would say that, what I've seen is that some people are not paying attention to sometimes is when you have coin to coin transactions. And so, like, let's say, for example, I have US dollars and I buy Bitcoin, and then I sell Bitcoin and I buy XRP. So then, as soon as I sold Bitcoin, that's one taxable transaction. And then when I open up the XRP, that's a new cost basis for that particular coin. And then if I sell XRP back to Bitcoin, that's another sales transaction. And then when I sell back to USD, that's another So it can be very complex. So the best thing to do is, like, there's a lot of API aggregation or coin tracking type companies where you can basically attach your wallet to that exchange or to that software company, and they can help you track your basis because it can get out of control if you're actively trading.
Right. Definitely. Um, Now, the next question is, can multiple traders co-invest together without forming an LLC?
Um, well, you got to think about an individual account first. Is if you're it's got to have to be in someone's social security number. Like you can't have a. I guess if you're married, then it would be the same thing. But like if we were just friends, would you be okay with me investing your money? You have to answer that question because the tax recording requirements is going to go based off of who that individual is. So my advice is to make things simple is just set up an LLC tax as a partnership. Me and Michael got 100 grand. We want to trade it. Let's put 50K in together. We're going to split it right down the middle. You get 50% of profit and loss. I get 50% of profit and loss and call it a day. So that way, if anything ever happens, I don't have to worry about your tax situation. You don't have to worry about my tax situation. You get a K1, I get a K1. It makes everything simple. That would be my advice in that scenario.
Right. And because the other alternative for that is just really a handshake deal, right? Like there's nothing on paper,
Hmm.
right?
Yeah, exactly. And you don't want to run in those situations. And then if like you're trying to take it a step further and you want to start investing on behalf of people, that's when you get into a whole nother layer of complexity. And so usually we have a relationship with a hedge fund attorney, which basically helps people set up what's called incubator funds. And so legally to like produce performance and to take on investors, you have to have a certain structure. You got to be accredited investor. Like there's a lot of different red tape that you have to follow. So if you are planning, like this question was like planning to go down the investment route, you definitely want to set up a hedge fund to do things properly and not just investing on behalf of people.
Makes sense. Makes sense. Last two questions here. Um, Puerto Rico is a hot destination for traders, I think.
Mm-hmm.
Is do you think, or I guess the question from our community is, do you think is moving to Puerto Rico for the tax advantages worth it?
Well, I have a lot of clients that have gone. I have clients that have come back. I guess from my vantage point is it depends on where you're at in your life. First off, right? It's because a lot of times people are so bent on tax savings, tax savings, tax savings that I'll do whatever I can not to pay tax. So you go to Puerto Rico under Act 60, you establish a permanent residency, you pay 0% tax on your capital gains. Now, um, with that said, though, is it all depends on your lifestyle, right? If you're a family guy and you like having your cousins, your mom, your dad, all that stuff around, it gets real lonely. Like I had clients over there mad because Amazon took a week for their package to come when they're used to having it come in 24 hours, right? So there's some quality of life things that might change. Now, if you're someone who loves the beach and you love being outside and you like sun, the quality of life there is fantastic. And on top of that, you're also getting 0% cap gain. So I guess you have to put yourself in a situation where it's like, does this make sense for my personal situation? I think if you could do it, I would be gone yesterday. But if you're someone that's like, hey, I don't know if this is for me, then you would really want to think about if that's the best decision for you and your family. But I think it's fantastic.
Yeah, it really differs by case, right? Depending on your current situation there.
Yeah,
Um,
yeah, and you only got to be there 181 days. So it's like maybe if you live in a Canada where it snows every time, you're like, I kind of want to get out of the snow. So maybe you spend that 6 months down in Puerto Rico, and then when the weather gets back good, and you come back home. Like that could be an option. So
that could work. Yeah. Um, okay, last question for this before we head into the live Q&A for the last 5 minutes. Do I need insurance for my trading business?
yeah, it's not something that I've seen, because again, if you recall earlier, I mentioned that you're not really selling anything. Like there's no chargeback situations. There's no products or services that you're selling. And so the insurance that you do have though is obviously each broker needs to be FDIC insured, right? So that's up to they have what's called no, sorry, not FDIC, SIPC. SIPC is 500,000. FDIC is 200, or I think it's like 200 grand, 250 grand.
Yep.
And so if something happens and there's a bank run and the broker goes to pieces, you already have SIPC. You should see that in your brokerage account application. They have SIPC insurance. Now, the insurance policy that I like is mark to market. And that's because if you have a bad year and something just happens and you just destroyed your trading account, you want to be able to recoup those losses as quick as possible on your tax return. And so I like to call mark to market as an insurance policy. But outside of that, I hadn't seen a situation where insurance was involved. Actually, I take a step back. It wasn't a client of ours, but I did see a freak accident where there was something going on with oil's futures with a brokerage firm. A couple years back, I think it was like a flash crash where this trader ended up owing millions of dollars to the brokerage firm. And I guess that's a 1 in a million type situation. But I guess if you had some type of insurance policy there, that might help.
Got it. Awesome insights, Brian. Thanks so much. Thanks so much. Before we head
Absolutely.
into, live Q&A for the last few minutes, we'll skip Brian a little break too. He's been, talking a lot this
Get
whole
some.
time.
Sure.
We'll just send a quick note, just some resources that I was talking about earlier, with regards to Brian's company's Trader Tax, CPA, Trader Files, as well as Brian's YouTube channel. But I will also send a note with regards to Composer business accounts. Composer Business Accounts is really your all-in-one quant trading platform, built for sophisticated investors, family offices, and emerging fund managers. It offers a complete end-to-end solution, uh, empowering you to like really build and execute fully customizable and automated trading strategies with intuitive no-code tools. Beyond trading, we can also support you with your business setup, structuring, tax reporting through our industry contacts like Brian's firm, at TraderTech CPA or TraderFyles. Um, I'll just provide the links below here.
Nice.
For Composer business accounts, we currently offer a free consultation. So if you'd like to book a free consultation, feel free to paste that last link. Just last minutes here, we'll just run through some of the live uh, questions in the chat here. A question from Corey. Is it possible to convert a brokerage account, crypto or individual, from a personal account into a new business account?
Yeah, that's a question I get a lot, and that's broker dependent. But if you recall earlier where I mentioned like, your social security number is tied to your individual account while your federal EIN or your tax ID is tied to your business account. I'm like 99% sure that there's no conversion that happens, but there's actually new paperwork that needs to be filled out. Now, what I've seen people do is like asset transfers. And so maybe you have positions that you're holding, and you're like, I don't want to liquidate this, but I still want to keep it, but I want it in my business account. You can do like securities transfers or custodial transfers, especially if you're at the same brokerage firm. But they will, I'm almost like 90, I don't want to speak on behalf of brokers, but I'm like 99% sure that they do require brand new accounts.
Awesome. And one last question here. What are the additional requirements for the LLC business if we also want to trade with other people's money?
Yeah, so you definitely, there's a few different ways. Like you can have the RIA model. So if you're a registered investment advisor, you have to get, I think it's the series, don't quote me on this, I think it's 66 or 67. And so you can invest on behalf of your clients. That's one route. There's also the fund model. There's a few different models, but you definitely want to make sure you get licensed and that you're doing things by the book. And then the only other way is like if you structured it as a loan versus like your investment on behalf of people. Instead, people are basically loaning you money at a stated interest rate, and then you're paying them back basically principal plus interest. But I would probably go the other route because investments do carry risk, and so before you invest in anything, make sure you understand the risks.
And thanks so much to Brian for coming and doing this webinar with us. And stay tuned for our next webinar. There will be details coming soon via email and our socials. So thanks so much. See you in the next one.